Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views.
Hey, good morning. Hope you had a great weekend. Monday, the 8th. We wrapped up a little camping, family time in the mountains. That was nice. But back at it. Futures up between 50 and 75 bips, depending on what indice you want to look at on the equity side here in the U.S. Gold up over 1,800 again. That's interesting. I'm tempted to stop calling it sad gold, but not yet. I'm going to still call it sad gold. Energy futures all pointing lower. WTI last I looked had an 88 handle on it. Bonds are bid, not meaningfully so, but bid nonetheless. Goldman Sachs, Morgan Stanley prime brokerage desks indicating that hedge funds decreased net exposures further last week, indicating that defensive posturing is increasing. So that's something to keep in mind. Take it, the contraindicator would be perceived bullish, because if we keep going higher, these guys who get marked on the month of how they're doing will fall further behind. Is the reality. VIX is now bid a touch. I'm looking at updated info. I think part of that is due to NVIDIA. We'll talk about that in a second. Gold. I want to have. I'm calling it sad gold, but I do want to have some exposure here. We had a pretty good trade out of GDXJ. And we bought some AEM off a really great quarter for them, company specific. The miners are tough. That's the reason I put out the ETFs for the mining space is you got so much company specific type news can work against you in that space, whether it's a strike. You got so many of these companies have operations in second, third world countries where who knows what can happen. You get an uprising, you get whatever. So there is some risk there. I do like that. That is one space where I do condone ETFs as at least a part of what you're doing. Certainly single names can have some more, you can drive alpha, absolutely. But I do like general exposure derived in ETF land for the gold space. So GDX is the big guys, GDXJ is the smaller guys. You will get more, you'll get a little more juice in the GDXJ just because of the inherent leverage that's associated with a smaller producer than a bigger one. But nevertheless, I do want to have some exposure there. I'm going to be a buyer on dips in that space. So the anti-inflation bill, that's pretty much as good as passed. It's got to get through the House, but that's going to be a done deal, it seems like. Going to get an EV adoption ramp is part of the thought here with the $7,500 credit to folks. And there is some, it's not as clean as that sounds. There are some rules around that. So dig into that. Don't go out and buy a bunch of EV stocks. But speaking of that, anyway, maybe even the better way to play that, it's always hard to guess the OEM winners. If you go with things like batteries and electronic component suppliers. So in other words, you buy a copper miner. These things are going to be, these batteries take up copper. Lithium, obviously they're going to take up, they need lithium. And in terms of electronic component supplier, Aptiv, APTV, great company, all things electronic when it comes to components in the automobile these days, the kind of stuff that can lead to autonomous driving one day. That one's interesting. We've owned it in the past, done awesome on it. They had a weak quarter recently. Stock is never really cheap necessarily because it is a high quality growth company. I haven't looked at it super recently, so I don't have updated metrics, but that's a good one to check out for sure. And then, again, my work shows we are starting to get a little extended on the move in the market in general, not like look out below necessarily, but a consolidation. SPYs, Qs, and also the Qs, we may get an indicator on as soon as Wednesday that things could get a little squishy out there. And CPI, I believe we get that on Thursday. But Nvidia pre-announced negative, so that's going to take down some of the semis. I don't think it's unexpected necessarily, but the magnitude's pretty big. 6.7 billion is what they're saying for Q2 top line. That's versus an 8.1 expected. That's a nice miss. Stock currently down a little over 7% in the pre-market. I expect that to continue. I wouldn't be in a rush to necessarily buy the first print on the dip there. I think you're going to get some people rinsing this thing that are just been wrong on it, have a loss on it, maybe bought it, didn't buy it that well. So I would look out for that. And this could be a couple quarters of weakness. Doesn't mean just because one quarter they're going to turn around next quarter and all guns blazing. So there could be a process here for these guys. That's it. So great company, but I wouldn't be in a huge rush necessarily. Have an awesome day. We'll talk to you tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.